What's going on, everyone? In today's episode, I'm going to be breaking down the financial shifts that we're currently going through, giving you some facts and giving you my own personal insights as to what I think to help you make decisions moving forward. If you're looking to buy a home, looking to sell, whether you should maybe do that now, in the future, and what all that kind of looks like. So let's get into it. So, since March of 2022, Jerome Powell and the Fed have been steadily increasing interest rates to combat inflation. I'm sure if you watch the news, you've heard this all over. It's just been the talk of the news for the last 18 months now. If you can remember, rates back in March of 2022, they're around 3.5%, 4%. Those same interest rates today, if you're lucky, you can get one at 6.99, all the way up to about 8.5%. So why this big drastic change in rates? What's causing all this stuff? Well, the rates have gone up, obviously, because we've been increasing interest rates to combat inflation. But there is a quote from Jerome Powell that goes into a little bit further detailing what we can expect if rates are going to continue to increase, if they're going to pause, or if they're going to lower, because the market has been tough when it comes to real estate. So Jerome Powell, during a recent interaction he had with David Weston on Bloomberg TV, shared intriguing perspective. He remarked, additional evidence of persistently above trend growth, or that tightness in the labor market is no longer easing, could put further progress on inflation at risk and could warrant further tightening of monetary policy. That's directly from the horse's mouth. Powell's stance was clear. The Fed's current policy isn't too tight. This, along with evidence that the economy is indeed managing high interest rates, does tell a story. Now let's talk about core inflation, which excludes the volatile elements like food and energy. There's been a deceleration to just 4% annually. However, a string of good data doesn't necessarily translate to inflation moving downward. As Powell articulated, inflation remains a tad too high. An interesting fact that caught my eye was the assertion that the Fed's rate hikes are exerting downward pressure on the economy. Powell hinted at more potential tightening in the offering, and also raised concerns about geopolitical tensions, calling them highly elevated. The recent attacks on Israel was termed as horrifying, heightening the severity of the global political climate. Shifting gears, let's talk about the job market. An intriguing piece of data from the Bureau of Labor Statistics highlighted the continuous churning of job positions. They've tracked the evolution of employment and the private sector establishments, giving us keen understanding to the net change in employment. So here's the breakdown. Gross job gains in Q1 2023. These gains represented 6.2% of private sector employment. This means jobs added at new establishments and existing ones that expanded. This culminated in an impressive 6.5 million jobs in Q1, though openings reduced by 135,000 from the previous quarter. Gross job losses, representing 5.4% of private sector employment in Q1. These are jobs lost due to contractions and establishment closures. We observed a dip of 467,000 jobs at contracting establishments from the last quarter. In establishment births and deaths, we saw a decrease by 13,000 in establishment births, tallying up to 331,000 establishments in Q1 2023. These new establishments corresponded to a total of 944,000 jobs. Now let's get into size of these companies. So firm size and impact. Now let's consider the size of the firms. Smaller firms, those with 1 to 49 employees, saw net employment surge of 317,000. Medium-sized firms, those with 50 to 249 employees, also experienced net job gain of 275,000. But the giants, firms boasting 250 or more employees led the pack with net employment spike of 512,000. So in the job market, everything is still very strong, which is not what we want to hear with increasing interest rates. If we're going to get interest rates to pull back, we need a softer job market. So all this is good. Although this is good for the economy, it is bad for interest rates. So looking at industries and states, so this is going to cover all the USA. So looking at sectors, 10 out of 13 industry sectors saw gross job gains, outweighing the gross job losses in Q1 of 2023. Service providing industries marked a net job gain of 844,000 in terms of geographical distribution. 49 states, including the District of Columbia and Virgin Islands, also experienced net job gains in the first quarter of 2023. So what does all this mean? Well, Jerome Powell and the Fed are obviously walking a very thin line on a tightrope. They're trying to bring inflation down to a level that is 2%. They may adjust that, who knows, but that's what they're trying to get to, is 2% annually. Can they get there without breaking down the economy? I don't know. I mean, no one with the crystal ball can really tell you that. I can see things have really tightened in the market now that rates have gone up as high as they've gone. But there is a lot all at play. We have a new election coming up in November. The presidential cycle is about to start. That will have an impact, I think, on the economy and on interest rates. We've already started to see some of the energy prices starting to come down again with fuel. So that should have a positive impact on the bond market. We have seen that the job market is softening in recent months. So even though the American consumer is still very resilient and still spending, I don't think we're going to see the amount of spending in the fourth quarter of this year, which will help bring down inflation as well. If we're spending less money, inflation is going to come back down because there's less demand for the goods being sold. So we're trending right now in a positive direction. Big question I get from all of my clients right now when I'm reaching out, speaking to them, this is probably number one thing on their mind, besides interest rates, is are we going to see a wave of foreclosures? Foreclosure data right now is very low. There isn't a whole lot of foreclosures out there in the market. You have to keep in mind, everyone that purchased a home in the last, since the crash of 2008, everyone's had to qualify. There hasn't been any crazy 80-20 loans where you only qualified on the interest rate, the introductory interest rate, and not the resetting one. Majority of homes right now, people that have sold are putting 10, 20, 30, 40, 50% down on their new purchase if they were upgrading. So I don't see a lot of financial risk in the market when these people have put a considerable amount of money down. So the markets are completely different compared to 2008. Everyone has to qualify. There's plenty of people that don't qualify in the market right now. One, because of interest rates, or two, they just don't have the down payment. If you're in the Southern California market, I mean, almost an introductory home right now is right around $800,000. That's a significant down. Even if you're buying a first home FHA, you're talking right around $25,000, $26,000, $27,000 to get your foot in the door. That's a considerable amount of cash still for a first-time buyer. So I just don't see that. I don't see home prices contracting a whole lot or coming down. I think right now, as the market slows down for this time of the year with the holidays, you're going to get very strong sellers, because if sellers typically sell in this time of the year, they are very motivated sellers to get their property sold. If a buyer is in the market right now looking to buy a home by the end of the year, they are very motivated buyers, especially with today's interest rates. And here's the thing for buyers. You can probably right now negotiate better terms as we end the year because rates are so much higher. A lot of buyers have been flushed out of the market because they simply can't afford a home, or they're waiting on the sidelines, which there's two coins to this. So this is just my perspective of what I think moving forward, how things are going to play in 2024 in real estate in general. So I think rates will start to come down, as what the Fed was saying. Jerome Powell has been saying. When I watch on the news with all these economists that are so-called experts, I think by sometime April of next year, and I'm a little bit of a pessimist when it comes to this stuff, April of next year will be 6 months almost to the election. I think rates will start to slowly come down, not a whole lot. I don't think we'll see a major jump. But I've seen some articles where by the end of 2024, rates might be below 5%. I think that is far too low. I think we'll maybe be somewhere around 5.5%, 6% is kind of where I'm thinking. But even if that is the case, around 5 to 6%, we are going to see a big surge in buyers coming back in the market. We're going to see a surge of everyone that bought a home in the last roughly 2.5 years refinancing their home. And for all the sellers that have a 3.5, 4% interest rate that have been on the sidelines waiting to sell their home, maybe making an upgrade, maybe moving out of state, whatever the case may be, they haven't wanted to make those moves because interest rates are double or maybe even triple what they have. But if rates go from a 3.5 and they can get a 5 or a 5.5, I think a lot of sellers in that category will make the jump, make that move if it's only that small gap. Going from 3.5 to 7.5 is a huge difference. But going from 3.5 to 5.5, that isn't too big of a gap. So I think a lot of sellers will come back in the market at that point, sell and upgrade. But keep in mind, if you're a buyer right now and you're waiting for that potential moment, you have to understand there is going to be a wave of buyers. So even though we might get more inventory during that time, there is going to be a ton of extra buyers that come back in the market trying to buy a home. So this is what I would say. If you can afford to buy a home now and you need a home, I would really consider making that move right now. Try to negotiate really good terms as we're entering a slow market in the fourth quarter of the year. People are putting their thoughts on other things right now with the holidays. You might be able to negotiate better terms for a property you really want, and you get to date the interest rate. You can't change the sales price after you buy the home, but you can change the interest rate through a refinance. So even if you get what would seem like a horrifying rate at 8% right now, maybe in 6 months, maybe in a year, you can refinance that thing down into a 6%, into a 5%. And keep in mind, you can refinance typically every 6 months. So even if you go from an 8 to a 6 and rates drop back down again in 6 months to 5%, you can refinance again. So you can't change the price. So if you buy a home for $800,000, but in a year that same home jumped up to $1 million, you can't go back now and try to renegotiate that, right? You're stuck paying what you paid for it. But you can always refinance. So that's just my 2 cents. If you can afford to buy it now, buy it now, deal with the high interest rate, refinance in the future, because there isn't, from what the data shows, there is not going to be a huge wave of foreclosures hitting the market that would significantly lower property value. And builders can't build quick enough to keep up with buyer demand. We are millions of homes short every single year with development. So any questions or thoughts, drop them in the comments below. I'd love to hear what you have to say. If you have any really, really deep burning questions that you need to reach out to me, you can always give me a call or send me a DM. Thank you so much for watching, and I'll see you in the comments. And as always, guys, don't forget to like, follow, and subscribe, and stay in line with everything I got coming up.